Target Corp recently dropped 20% to $125 a share. The reason for this was their earnings, and the market didn't really like it. The share price before earnings was $156, and as I said, dropped 20% to $125. This is the lowest price Target has been all year. And is this the right time to buy? That is the question we're going to be answering today. We're going to look at my automated stock valuation spreadsheet to see if Target is buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So let's go back to the start and put the ticker TGT in here, and we will get all the latest company financials and we can have a deeper dive. So as I said, $125 a share, market cap of $57.6 billion, PE ratio 13.25, so that's price to earnings ratio, and it is a lot lower than the market average, which is currently around about, okay, you can have my cookies, 30.52. Earnings per share, $9.44, and a beta of 1.25, meaning it's more volatile than the market. Analysts do say to buy $143 a share, and they do pay a dividend, a very nice dividend actually, 2.78%, which means over the course of a year you will get paid $3.59 a share. Is it safe? Yes, we have payout ratios of 36 and 31%. This is the payout ratio from profit and payout ratio from free cash flow. 1.7 billion, so very, very safe. And if you want to get paid your quarterly dividend by before the 20th of September 2025, and you'll get paid. So we have the numbers here, but let's look at the breakdowns. Revenue, not all-time highs, 107 billion, down from 2023, slightly up from 2024, but you can see they have big growth after something happened in 2020. They did sustain that growth, but the last few years have been flat, but 5-year growth is still increasing. Next, what are they doing with that revenue? Are they generating more profit? And the answer is, well, no, not what they were doing compared to 2022. Yes, more than 23. Yes, more than 24. Trailing 12 months, 4.49 billion, but not as profitable as they once were. Free cash flow, is it a similar story? Yes, it is. 5.27 billion, up from 24 and up from 23 where it was negative, but once again, not beating that 21 number. Now, if we look at the operating cash flow, is operating cash flow up? And the answer is no. You can see here, operating cash flow is down in the trailing 12 months, but CapEx is down as well, meaning we still have positive free cash flow. But compared to 2024, operating cash flow is down quite a bit. So let's have a look. Oh, we can quickly look at shares outstanding. They do consistently buy back their shares. So they're rewarding shareholders via share buybacks, which is good. So let's have a look at the discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. Right off the bat, it's giving $255 a share, meaning it's trading at 104% discount. Let's have a deeper look at those numbers. Revenue estimates, see based on averages here, we're expecting 110 and 113 billion. This is because we're looking at the 5-year average here and 13% in 2022. So let's have a look and see what analysts are saying in terms of the revenue. Analysts are saying 105 and 108 billion, or 107, well, 106, 109, and they're also expecting negative growth in the current year, but positive growth in the next year. So that is good. So we said 107, 109. We're a little bit on the bullish side, so we'll bring that down just a smidge, 1.5%, 107, 109, a little bit more bullish, but still $224 a share. Next, we'll look at the margins. Margins all over the place. We'll take an average of these last 3 years. I think that is a little bit fairer. 3.5%, $193 a share. And finally, net income compared to free cash flow. Well, we'll take an average of these last 2 years, and that gives us 120%. But as you can see, it still does like the stock at $128 a share. If you're interested in this sheet, please check out my Patreon, links are in the description, sign up. We have the valuation spreadsheet here at $5 a month, but if you want to help me out, and that would be very appreciated, anyone who buys any of these, I'm very appreciative. But $1.50, you can help me out, and $5 for this sheet. And this gives you full access. You can do your own stocks, you don't even need to watch me. But I prefer it if you did, obviously. Right, next we'll have a quick look at the dividend discount model. Discount rate, which is the current weighted average cost of capital, put at 8%. We've got expected growth at 5%. That would put it at kind of a, well, if we brought it down to say 5.2%, that puts it fairly valued. But you can see the yearly dividend has been kind of all over the place here. But if they keep growing their dividend, at about 3 to 5%, then that is what we want to see. Ben Graham formula for intrinsic value. This is a way of valuing stocks by the godfather of value investing himself. Ben Graham looks at earnings per share, PE of a non-growth company, AAA bond yield, corporate bond yield. AAA bond yield is currently still 4.95%, so very, very high in terms of inflationary environments, or high. Well, let's go back because people will say this isn't high, but if we compare to more recent times, let's see. So we're basically back to 2011 numbers, but it was from 2012 till 2020. Things were good in terms of inflationary times. But still, I think we saw that the analysts expected in the next year 7.5% growth, 7.52. So we'll close this down. We'll put this in here, 7.5%, and puts it at a fair value at $134 a share, and a Graham price, which is a margin of safety, at about 100. So Ben Graham would say it's probably slightly undervalued at the minute. So a buy, but with a sort of 25% safe margin of safety, it wouldn't be a buy. I want to get a little bit lower, but this has just been a massive drop off, so that's probably why. So finally, we'll look at the comparable company model. This is a way of valuing companies, looking at their competitors in similar industries and sizes. And then we're going to look at revenue growth rates, EBITDA, net income, profit margins, price of sales, price to book, PEG. And I said Peter Lynch is there. I always do that. No, sorry, I said Peter Griffin's. That's because of the G. Peter Lynch's price to earnings growth. EV to revenue, EV to EBITDA, PE, and we do look at some forward PE as well. So some companies that I do think are comparable. $1 General, ticker symbol DG. Costco, ticker symbol COST. And we'll do Walmart as well, WMT. So this will load all the latest company financial data, and we can have a compare and then see what the implied share price is based on these. So enterprise value, Walmart biggest, 10 times the size. Costco 4 or 5 times the size, 6 times the size, can't do math. Dollar General is about half the size. Revenue, 100 billion, all kind of scaled here. Growth rate, all growing. Actually, Walmart is the least, 4.7%. Target in the upper side, just below Dollar General and Costco. EBITDA, second highest. Net income, third highest. Highest profit margins, 4.19%. So that is pretty interesting there. Price to sales, market average is 3.2. All of these companies are below it, but Target is the second lowest. Price to book, I think the market average is about 5.25. Only Target and Dollar General are lower, so interesting. Then Peter Lynch's price to earnings growth. What he ideally would like to see is under 1 is undervalued, over 1 is overvalued. So you can see these are all over 1, but Target is the lowest, 1.48. So now we have EV to revenue, EV to EBITDA, PE. PE, one of the lower PEs, one of the lower forward PEs, gives an average of 280. So what we'll do is I'll remove Costco and Walmart because they do trade a much higher multiple. We'll throw Kroger in there, ticker symbol KR. And I do want another one. Best Buy, BBY. I think it's BBY. Interestingly, puts it about fairly valued, $130 a share. So all these are looking a bit more undervalued, but not quite trading at the high multiples of WMT, Walmart, and Costco. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.